Ever heard terms like assets or liabilities and thought, what did I just hear? Don't worry, you're not alone. Today we're decoding financial jargon. No suit and tie required. Let's make money talk and actually make sense. A balance sheet is like a financial snapshot of a company, showing what it owns, assets, and what it owes, liabilities, at a specific moment. The equation is pretty easy. Assets are equal to liabilities plus equity. It's one of the most important documents for businesses because it helps you see if the company is financially healthy or if it's in trouble. Think of it like checking your phone's battery. You want to know if you're running low or fully charged. Liquidity is like the cash in your wallet, how easily you can get your hands on money when you need it. Stocks are pretty liquid too, since you can sell them quickly. But things like real estate or land are much less liquid because they take a long time to sell. In short, liquidity is how fast you can turn stuff into cash without breaking a sweat. GAAP stands for Generally Accepted Accounting Principles. These are the rules and guidelines that companies must follow when preparing their financial statements. Without GAAP, companies could present their financials in many different ways, making it hard to understand or compare them. It's the foundation for clear and honest financial reporting. Capital gains are like finding treasure. You buy something, like a stock, for $100 and over time it gets more valuable. If you sell it for $150, you've made $50. This is your capital gain. The best part? You only pay taxes on it when you sell the treasure, not while you're holding it. Net income is the total amount of money a company makes after all expenses are subtracted from its revenue. It's often referred to as the bottom line because it's usually the last line on the income statement. Net income shows how well the company is doing, basically if it's making or losing money. Equity is the part of something you own, like a house or a company. It's calculated by subtracting any debts you owe from the asset's value. You can even have negative equity if you owe more than the asset is worth, like if you have a car loan. Depreciation is the decrease in an asset's value over time, like watching your car go from brand new to clunker as it ages. It's most relevant for physical assets like machinery, vehicles, and technology. The reason this matters is that it affects both the asset's worth and the company's financials. Earnings per share is like the company's report card. It shows how much money the company makes for each share of stock. You get it by dividing net income by the number of shares. If the EPS is high, it means the company's doing well. Basically, it's acing the test. So, more EPS means more cash for everyone. Alright, those were just the first few financial terms. Click here to watch part 2, where we'll continue with more important concepts.